Bank runs and the potential for a new financial crisis. The term bank run is used to describe a situation where large numbers of customers withdraw their money from a bank due to a lack of confidence in the bank's ability to repay their deposits. Bank runs have been around since the early days of banking, but recent events have raised concerns about the potential for a new financial crisis caused by bank runs. In March 2023, Silicon Valley Bank experienced what some are calling a bank run, when customers withdrew more than $1 billion in deposits over just 2 days.
The bank let us know that they expected the outflow to be vastly larger based on client requests and what was in the queue. A total of $100 billion was scheduled to go out the door that day. The bank did not have enough collateral to meet that.
This was followed by similar withdrawals at Credit Suisse and First Republic Bank. The rapid withdrawal of funds has raised fears that these banks may not be able to withstand further withdrawals and could face bankruptcy if the trend continues. The Federal Reserve has responded to this situation by providing liquidity support to these banks. But some experts are concerned that this may not be enough to prevent a full-blown financial crisis.
The Federal Reserve has a lot of discretion regarding the requirements that they can impose on banks with assets over $100 billion.
Economist Paul Krugman warned that if we don't get ahead of this problem quickly, it could become an even bigger mess than it already is. He went on to say that we need to make sure that banks don't fail because of panic withdrawals, or else we risk triggering another financial crisis. The fear is that if one or more of these banks were to fail due to bank runs, it could trigger a domino effect in which other banks would also experience large withdrawals and potentially fail as well. This could lead to widespread economic disruption and cause significant losses for investors and depositors alike. It remains unclear what steps the Federal Reserve will take next in order to prevent such an outcome from occurring. Some experts suggest increasing interest rates or imposing stricter regulations on banks in order to reduce the risk of bank runs, while others argue for increased transparency so that customers can better understand how their money is being used by banks. No matter what steps are taken, it is clear that preventing future bank runs must be a priority for regulators in order to avoid another financial crisis like the one experienced during the Great Depression. As economist John Maynard Keynes once said, "The avoidance of all banking panics requires not only courage but also foresight, not only action but also anticipation, not only wisdom but also knowledge." Sure, a bank run can have significant effects on both the bank and the broader economy. Here are some potential effects of a bank run. Number 1. Bankruptcy. A bank run can lead to bankruptcy if the bank is unable to repay all of its depositors. This can happen if the bank has invested a large portion of its deposits in risky assets or if it has too much debt. Number 2. Economic disruption. If a bank run spreads to other banks, this can cause economic disruption as investors and depositors lose confidence in the banking system. This can lead to a sharp drop in the stock market, a rise in interest rates, and a reduction in lending by banks. Number 3. Job losses. A bank run can also lead to job losses, as banks may need to cut costs in order to stay afloat. This can have a ripple effect throughout the economy, as other businesses that depend on the banking sector also struggle. Number 4. Loss of trust. Bank runs can erode the trust that consumers and investors have in the banking system. This can lead to a long-term reduction in the amount of capital that is available to banks, which can make it more difficult for them to make loans and invest in the economy. Number 5. Government intervention. In some cases, a bank run can lead to government intervention in order to prevent a broader financial crisis. For example, the US government established the Troubled Asset Relief Program during the 2008 financial crisis in order to provide support to struggling banks. Overall, a bank run can have significant and far-reaching effects for both individual banks and for the broader economy. It is important for regulators and investors to take steps to prevent and mitigate the risks associated with bank runs in order to avoid the worst effects of a financial crisis. A bank run occurs when a large number of depositors try to withdraw their money from a bank simultaneously due to concerns about the bank's financial stability. When a bank experiences a run, it can have significant knock-on effects on the broader economy. Here are the potential effects of a bank run on the economy. Number 1. Reduction in liquidity and credit availability. A bank run can cause an immediate reduction in the bank's liquidity, as it is forced to use its cash reserves to meet a sudden demand for withdrawals. This can, in turn, reduce the overall availability of credit in the economy, making it more difficult for both individuals and businesses to obtain loans. Number 2. Loss of investor confidence. A bank run can lead to a broader loss of confidence in the banking system, as depositors fear that other financial institutions may also fail. This can lead to widespread loss of trust that can have long-term effects on the financial system as a whole. Number 3. Stock market and bond market volatility. A bank run can cause severe disruptions in the stock market and bond market, as investors begin to sell their holdings in banks and other financial institutions. This can lead to a rapid decline in stock prices, which can create a broader downturn in the economy. Number 4. Economic recession. If a bank run leads to a broader financial crisis, it can cause an economic recession. This can occur if the run leads to a drop in economic activity, less investment, less job creation, and less consumer spending. This can lead to a vicious cycle where businesses lay off workers, leading to even less consumer spending, exacerbating the problem. Number 5. Government intervention. Finally, governments may step in to try to prevent the crisis from spreading, which can have multi-year effects on the economy. If the government offers bailouts or financial support to struggling banks in the wake of a run, it may lead to a broader sense of mistrust among the financial sector and may lead to long-term changes in the way the financial system operates. These are just a few of the ways that a bank run can impact the broader economy, and it underscores the importance of ensuring the stability of the financial system in order to avoid the worst effects of a crisis. Regulators and investors can take active measures to prevent a bank run. Here are some ways they can do so. Number 1. Increase transparency. Regulators can require that banks provide more information about their financial positions and investments so that investors and depositors can better understand the risks associated with a particular bank. This can help prevent a run by reducing uncertainty and increasing confidence. Number 2. Implement deposit insurance. Most developed countries have established deposit insurance schemes, where deposits up to a certain amount are guaranteed by the government. This helps prevent bank runs by reassuring depositors that even if a bank fails, they will not lose all their savings. Number 3. Require higher capital adequacy ratios. Regulators can require that banks hold higher levels of capital relative to their assets. Higher capital levels make banks more resilient to losses and help prevent a run by increasing confidence in the bank's ability to withstand financial shocks. Number 4. Monitor interbank lending. Regulators and investors can monitor the interbank lending market, where banks borrow from and lend to one another. If a bank has too much exposure to another bank that is experiencing difficulties, it can increase the risk of contagion and lead to a bank run. Monitoring these activities can help prevent a run from spreading. Number 5. Central bank support. Central banks can step in to provide liquidity to banks experiencing a run. This can help stabilize the banking system and prevent a broader financial crisis. In summary, regulators and investors can take steps to prevent a bank run, such as increasing transparency, implementing deposit insurance, requiring higher capital adequacy ratios, monitoring interbank lending, and providing central bank support. By implementing these measures, we can help ensure the stability of the financial system and avoid the worst effects of a crisis. To prevent bank runs, regulators and investors can take the following steps. Number 1. Increase transparency by requiring banks to disclose more information about their financial positions and investments. Number 2. Establish deposit insurance schemes to reassure depositors that their money is safe. Number 3. Require higher capital adequacy ratios to make banks more resilient to losses. Number 5. Monitor interbank lending to prevent the spread of a run from one bank to another. Number 5. Provide central bank support by injecting liquidity into the system to stabilize banks that are experiencing a run. Overall, these measures can help prevent bank runs from occurring and mitigate their impact on the financial system if they do occur. Credit Suisse, one of the largest banks in Switzerland, recently faced bankruptcy. In March of 2023, Credit Suisse's owners were at risk of losing all their equity in a bankruptcy. To prevent this, Swiss bank UBS stepped in and took over its competitor Credit Suisse for more than 3 billion Swiss francs. The European Central Bank Governing Council member, Pierre Wunsch, said the probability of Credit Suisse Group AG going bankrupt was very low, due to the intervention from UBS. Despite this, hedge funds that bet on the rescue deal still faced losses as some of their bonds were written down to zero. The potential bankruptcy of Credit Suisse would have had a huge collateral damage on the Swiss financial system, according to Karen Keller-Sutter, president of the Swiss Confederation. Ultimately, UBS's purchase of Credit Suisse was a forced marriage after bankruptcy and prevented further economic damage across Europe. Bank runs have the potential to cause significant economic damage, with far-reaching consequences for individual banks and the broader financial system. The recent example of Credit Suisse facing bankruptcy underscores the importance of ensuring the stability of the banking system and taking steps to prevent bank runs.